going? Today we're going to talk about the basics of life insurance. Now, life insurance can be categorized into two types. There's term insurance and then there's permanent insurance. With term insurance, the money that you're putting in equals the cost of insurance. So you can see that over a period of time, since you're only paying for the cost of insurance, it's going to be the cheapest product that there's available. But it's kind of like renting, because when your period is done, then there's no money that you're getting back, and it's your benefits have now lapsed, and you may need the coverage even more in the future. But it is definitely the lowest cost solution. The second type of solution is a permanent policy. And in the permanent policies, the premiums that you're putting in are greater than the cost of insurance. And so if you think about it as a bucket, you have your fixed expenses within the policy, like administration fees, the cost of insurance, and I'm sure there's some contract fees and stuff like that. But that's the base cost. Anything that's above that base cost is going towards investments. And so you have different funding levels that you can fund a policy with. On the lower end, you could have a no-lapse guarantee for 20 years. And then on the higher end, you could have the modified endowment contract, which is basically the most amount of money you could put in per year. And so, and they actually call that max annual premium. Modified endowment contract is a one-time distribution or contribution that you can put in. And so over a period of time, you create these buckets, and you can fund these buckets in different ways. And I can give you two quick examples right now. Is that, let's say you don't have a lot of money right now, but you're expecting an inheritance or some infusion of capital. Well, then you may want to fund it on the lower end of in excess. You can put a lump sum in all at one time. On the opposite end, you can max fund these policies each year. And the reason you would want to do that is because you don't know what's going to happen in the future. So you want to make sure that these policies are well funded. Now, both of these options will create two totally different types of policies. And so we're going to look at that right now. So if you had a policy and you underfunded that policy, chances are that cash value is not going to grow, and you may run out of money later in life in the policy. And so you may come to a point where you have to make a decision is whether or not you want to keep this policy. On the other hand, if you overfund this policy, then this policy will continue to grow, and your death benefit may increase so that it stays in a life insurance policy. This will give you flexibility in the future. You can take money out, you can continue to grow the death benefit, you could stop paying premiums in, and so you have options at that point. The next thing that I want to talk about is the fact that you can use life insurance in terms of planning. And the reason is that the life insurance piece, you can structure in a way that's outside of your estate, and you don't have to pay taxes on those dollars. And this is called an irrevocable life insurance trust. And some policies that you can get are insured on two people's lives. So it's called second to die policies. And you put these policies into a trust, and at the passing of the second person, so if it's husband and wife, the passing of the second spouse, the policy will pay a death benefit to the beneficiaries at that point. Now, the key to understanding life insurance is how much do you actually need, right? And so what I like to do is kind of like a field goal post. So on one end, you have what's called your basic survivor's needs. So what is the minimum amount of money your family needs to keep their head above water? This could be calculated as basic expenses times for 5 years, and you can estimate that pretty well. On top of that, you could add, like college savings goals or anything specific to be in alignment with that. And then on the opposite end, you have what's human life value. So for example, if you were to get hit by a drunk driver and your spouse goes to see an attorney and they say, what was the economic impact that this individual had on the family, they would calculate a human life value. And then that is basically your projected earnings between now and retirement, discounted to get a present value for today. And then that's how much would really give you the upper end. And really for families, my suggestion is that you stay somewhere in between that goalpost. And it's a personal decision. It's totally up to you. But One thing that we found is that through life, the amount of insurance you need kind of goes up and then goes back down. So what I mean by that is that when you start your first job, you first get married, you need a little bit more insurance. You have your first house purchase, you need a little bit more insurance. You have your first child, you need a little bit more. You have your first kid in college, or second kid is born. First kid in college, you need more, and more. And eventually you get to a point where you reach the max, and then it's probably in line with peak earning years, and then you need less as the time goes on. And for most people, if they've saved enough assets in retirement, they won't need much life insurance at all. Maybe something as simple as a end-of-life policy to pay for unexpected expenses around death. And for some people that have saved a lot of money, then life insurance comes back into the picture as a way to create liquidity for the estate. And so there are many different uses that can work for someone's retirement or estate planning for insurance. If you have questions, we'll be happy to help. Just you can reach out to us and contact us in the information below. Thank you.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Client First Capital LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Client First Capital LLC and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Client First Capital LLC unless a client service agreement is in place.